Okay, so the source document is a credit note. Are we issuing the credit note or receiving the credit note? I'll ask again, are we issuing the credit note or receiving a credit note for a sales return? We are issuing it to the customer. The qualitative characteristic that upholds is reliability. Evidence that a transaction is fair, free from error and bias. Just like it is for a purchase return, there is important information that should be included on a credit note, such as quantity. Now, is it our cost price or the price we sold it for on the credit note? You're not going to put our cost price on the credit note. Do you want the customer to know how much it cost you? No. So what do we put on it? The selling price. Good. So the selling price and the GST associated with it. So from there, you will have the total that's going to be refunded to the customer. And the refund, in this case, takes the form of a decrease in debtors, the subsidiary ledger and the control account. So as I said when I taught purchase returns, sales returns is a little bit harder for two reasons. One, there are a lot more entries because there's selling price and cost price entries. And two, we don't know the cost price on the credit note. So we have to have a way to work it out. And we talked about it last week, but I'm going to do examples with you today so you understand. Okay, so we record the sales return in the stock card, just like we did the purchase return, but I'm just going to show you something from the study design. So this is from the study design, and it says, the FIFO assumption is applied to all goods sold. It allocates the older prices first to the goods that have been sold, with the most recent prices remaining in stock. That's not new learning, you knew that already. When a customer returns a sale to the business, these goods must be returned to the stock card as they are again part of our stock on hand. So what column will it go in the stock card? The in column, good. As FIFO is applied, the process is simply reversed if it returns. Okay? So when first one's in, now the first one's out. So we reverse the entries when we're doing a sales return. Purchase return was easier because the cost price was on there and that's the stock that goes back in. But for this one, we actually have to do it keeping the FIFO in the balance column by reversing the entries. When we do a few, it'll make more sense. Okay, so recorded in the stock card, in the in column, reverse, so FIFO is maintained. Maintained. That doesn't look right, but we'll leave it. Are you writing this down? Alright, general journal. Okay, there are a lot more entries in the general journal. And as I taught you with the sale, I break them down into selling price and cost price entries. I do the same for a sales return. In the general journal, I no longer have the sale. So there is a new account that is created called sales return. It's treated as a negative revenue or a contra revenue account. It is decreasing our revenue. When I sold the goods, it increased the revenue. So therefore, if the customer returns it, it has to decrease the revenue. So will that be a debit or a credit? Debit, good. When I sold the goods, the GST clearing would have increased and I would have credited GST clearing. Now that I have had the goods returned to me, I no longer have that obligation to the ATO. So will I debit or credit GST clearing? Debit it as well, good. Phone away. So that's a liability decreasing. When I issue the credit note, I'm telling the debtor they no longer owe me that money. So what's going to happen to debtor's control? It's going to decrease. So is that a debit or a credit? So that's an asset that has decreased. The subsidiary ledger, the individual ledger account for the debtor who received the credit note, must also decrease. So in the subsidiary ledger, that would be a credit. Now, you know you don't have to write debtor name. I just do that because we're not using actual names here. It's just to remind you that it's a debtor decrease. So all those 4 entries are to deal with the selling price of the goods. All good to there. When we sold the goods, there was cost price entries as well. You know when we do our sales journal and we do the little V over the cost and we say debit cost of sales, credit stock control? So we have to reverse those entries as well. First of all, in the stock card, I have said the stock has gone back in. So what's going to happen to my stock control? It's going to increase. So is that a debit or a credit? Debit entry. We are now saying that sale never occurred. So the expense associated with that sale, which we call cost of sales, has no longer occurred. So that expense is going to decrease. So what entry is that going to be?
Credit.
Credit, because it's an expense decreasing. So you can see a sales return has a lot more entries than a purchase return. How many does a purchase return have? 4. 3 including 3 plus the subsidiary ledger. A sales return has 6. Okay? So it's really important when you're reading SACs and exams, be very clear whether it's a stock purchase return or sales return, because there's a lot more entries associated with that. If I was going to write a memo, what would I start with? Narration, sorry. If I was going to start a narration, what would I start with? A credit note. So I say what it's for, damage. Now, a very common question that students ask, but what if what they return back to us is damage? Why are we putting it back into our books? So we'll have to send it back to them, or we'll have to write it off, which is a topic that's coming up in a few weeks for us as well. All right. Any questions about those entries? Close that laptop for me, please. Can you put that on top, please? Should be writing in your modules, that's what I asked. Any questions about that? Okay, next stage. These are the same T accounts, so you don't have to redraw them. These are the same T accounts that we did last week. Okay, so find your old T accounts. We're going to add them into here so you can see the effect. I'm going to do it in a different colour so you can see. We're going to have to draw up one new T account. What new T account do we not have? We're going to have to draw up 3 new T accounts. Sales return, cost of sales, stock control is already there. Debtors control and the subsidiary. Okay, so draw yourself up some new T accounts, please. Okay, we're recording again. Now we're going to put in the sales return entries, and I'm just going to do them in green so they stand out. So these are the entries we just wrote down before in our notes. What's the first debit? Sales return. So find your sales return account. It's a negative revenue. What side am I going to write on? The debit side, always end date. The cross-reference is the name of the other account affected. The other account affected would have been the credit entry. So what would that be? Debtors control good. And let's not return all the goods. We'll return 4,000 of them. Oh no, let's return all of them. Bad luck. 6,000. The most common mistake students do here is put the GST in the sales return account. It doesn't go in there. It's debit sales return, debit GST clearing. Those two match up together. So sales return gets a debit of $6,000. GST clearing. What's the cross-reference going to be? Debtors control. And now you can see the stock that we bought had the stock that we sold collected GST. Now is not going to have to be collected, so that's why they sort of cancel each other out, so they all got returned. So debit sales return, debit GST clearing. What's next? Credit debtors control. There is a silent D. End date. What's the cross-reference going to be? Sales return slash. Beautiful. Then we have to deal with the debtors control. The debtors subsidiary ledger. What side am I writing on? We'll put it back on the 22nd. The cross-reference in the subsidiary is always the same as the control account, so the cross-reference is going to be sales return slash GST clearing. That's all the selling price entries done. Do you have a question or you're all good? Alright, so we have now got rid of the sale in terms of the selling price entries. We've still got 2 more entries to go. What are they? Debit,
Stock control.
stock control. Why are we debiting stock control? The stock is coming back in. The cross-reference is the name of the other account affected. What's that? Cost of sales. Good. Alright, what's the other entry? Credit cost of sales. Good.
Absolutely.
The cross-reference will be the other account affected. And that's all the entries done. Correct. Okay. Any questions about the ledgers? Alright, let's move on. So now, as always, we need to talk about the effect on the accounting report. Okay, first of all, the effect on the income statement of a sales return. Remember, the best way to do it is exactly the same way as I taught you with the purchase return. Look at all this information, because this tells you what's happened. So the effect on the income statement. Which ones affect the income statement? The negative revenue and the expense. Okay? We're crediting the expense. So are we increasing or decreasing the expense? Decreasing it. And the sales return is doing what to revenue? Decreasing it as well. So the first thing you have to say is you have a new account called sales return. That is written in the income statement. So now a new line in our income statement will be sales less sales return. And the reason that we do that is to work out a new figure called net sales. Why do you think it's important to work out a net sales figure and know what our sales returns are? Yeah. Absolutely. It's a measurement of performance. If you have a high sales return that is leading to a low net sales, what is that saying about the stock you're buying? It's either, we're recording, remember, it's either not good stock or you're not meeting the customer's needs. So you might have to look at getting different stock in. So it's a great, and I'll be writing this down if I were you, it's a great measure of performance. It helps the owner make decisions about their stock mix. You know, find different suppliers if it is always faulty.
What about like increase sales return?
Yeah, that's the next thing we do.
How would you just know if it's done? Like,
It'll be written on the credit note, because you have to write the reason for the return on the credit note, and it will be in your general journal also.
what if it was like a return for wrong size or something?
Bingo. Okay, so that's what, if you were the manager and you're in charge of looking at your sales figures, you'd say, hey, we've got a high sales return, let's have a look at our figures. And then the figures might say something like, yeah, lots of them is for wrong specification. So they're saying, well, that's not really our fault, that's our customer's fault. A few years ago, when I first worked at Myer, for example, we take returns, you didn't have to have ID, you could just return stuff because we wanted to try and keep our customers. They obviously worked out there was way too many stuff coming back for the wrong reason, so that's why they put in that ID thing, to try and make it a little bit harder to lessen the amount of sales returns. And that's what they'll try and do. They'll try and minimise their sales returns. That's a good question. Okay, so sales returns is decreasing our net sales.
So that first thing.
Yep. So we're doing this effect now. It decreases net sales. It also decreases our expense on the sales return, but which number will be higher? The net sales figure or the decrease in expense figure? The net sales figure will be bigger because we'll always sell it for more than what it cost us, yeah? So the overall effect, if I think of our example, net sales went down by 6,000, but our expenses went down by 3,000, so the overall effect will be a decrease. It'll still be a decrease. And what will that overall affect? Yeah, just net profit, or will it affect back up the line?
G.
Will it affect gross profit?
Yeah.
Because all this is before, it will also affect both. So you make sure, because you never know in the exam whether they're going to ask for the effect on gross profit or net profit or adjusted gross profit. All right, any questions there? All right. I've covered all the income statements there. Okay, effect on the balance sheet. This one's a little bit harder because there's so many accounts affected. Let's go back. We've got a liability affected and we've got two assets that are affected. So let's go through it. What assets are affected?
Debtors control.
So debtors control is going to go up or down?
Down.
Down. What's the other asset?
Stock
Stock control, is that going to go up or down?
Up.
The overall effect, same as before, we always sell things for more than we buy them. So will the overall effect be an increase or a decrease in
Overall
that debt?
decrease.
Beautiful, good.
Ooh.
Yeah, boy.
Sorry, boy,
Our liabilities, GST clearing. Is that going to be increase or decrease?
Decrease.
Decrease. Will our owner's equity be affected? It sure will be. Will it increase or decrease owner's equity? Decrease, absolutely. What will get decreased in owner's equity?
Capital.
The overall capital, because beautiful. The decrease in net profit will lead to a decrease in the owner's equity. Because I might ask in the exam which account is affected out of the balance sheet. So it's really important to know which ones are. All right, is there any questions about that? All right, we're not going to start an exercise today because we won't get it finished, and I want to make sure you understand that.